Welcome back to Tesla's cryptoverse, or I should say Lamb's Teslaverse. So today I'm going to talk to you about Tesla. It seems like a lot of crypto people like talking about Tesla. I used to wonder why, and I think it's because it's like a second order thinking. If you think in first order, like what's going on with Tesla now, they ain't doing too well. So the point is, you got to look at the company in the future, and then you could understand it. The same way with crypto. Crypto isn't doing too well right now. I mean, actually, the prices have done pretty well, but it's not being adopted as much as people think because it's too early, and you need to think about the future use cases. So today we're going to talk about why and I think it's a balanced approach. Why I think Tesla is having problems, and they're pretty bad short term. The stock go down quite a lot, but the future is bright. And my prescription for them is a subscription, meaning I think they should move from just selling cars and getting cash flow from that to lowering the price of their cars and move into a subscription model for the full self-driving, which is a bad name, by the way, because it's not really full self-driving. It's level 2 ADAS. So it's ADAS, or in terms of what the SAE calls assisted driving. It's level 2, going on level 3. So it's a pretty good, somewhat semi-autonomous platform for driving a car. So let's get started. I'm going to do this pretty fast. So first of all, what's going on with Tesla? I'm not going to spend too much time on this because everyone knows Tesla's having a big problem right now. The industry is weak, and Tesla's having problems too on its own in terms of the company itself. So Dan Ives, I'm not sure if you know him. He's a Wedbush analyst, equity analyst. He called the last 2 quarters an unmitigated disaster, and he's probably right. The unit sales are falling off a cliff. They're producing more cars than they're delivering. The selling prices are falling down. They're rapidly declining. They've got a lack of new car models. There was an arson attack, a fire attack in Berlin, in the Gigafactory, as they call them. They've got production issues, not only for the Cybertruck, which is new, so it's understandable, but even the Model 3, which has been around for a while, they're doing a refresh. So they had some production issues with the Model 3. And of course, everyone is pissed off at Elon Musk. And you can see in this chart here that they've got 23% global battery electric vehicle market share, according to evvolumes.com. That seems a little high, but actually this is just EV market share. But if you look at overall market share, the market share is much lower. Like if you comparing total cars, meaning ICE cars, internal combustion engine cars, and hybrids and electric cars, their market share is very low, like around 11%. So they have a big runway to go. But the key point of this slide is they're not doing well. So this is the industry slide. So basically, Bloomberg says that EV adoption is going to continue strong. And the J curve is going to continue, the J curve of adoption. But this year, 2024, is so far not been a good year for electric vehicle sales. But Bloomberg does not seem to be reflecting that. Next slide. This is the industry structure. This framework was postulated by Michael Porter over at Harvard Business School. I'm not going to go over all these points. It would take me like 10 hours to do that. I'm only going to go over a few points. The point is, my point of these few points is that Tesla is in a unique, strong position within electric vehicles and within total automobile industry. So within the auto industry, Tesla is in good shape. The only place Tesla is weak is in China. China has something like 250 electric vehicle car makers that are doing very well, and some of them are very profitable, like BYD. I got to be honest with you, I don't trust these numbers because the Chinese industry has been known for years as being copycat of other industries, and it's highly subsidized. So I find it hard to believe that BYD is that much better than Tesla. I don't know. I mean, BYD does have a core competency, is that their core business is batteries. They were a battery company. And if you look at an electric vehicle car company, about 30 to 40% of those costs are from the battery itself. So maybe that's why they're doing well. But I cannot believe that the other, whatever it is, 249 EVs in China are much more profitable than Tesla. But either way, I just want to give you the facts. So let's go back to Tesla. Why do I think they're in such a strong position? Other than China, the lowest cost producer. The new entrants in terms of EVs are very weak. Faraday Futures is near bankruptcy. Polestar's in bad shape. Rivian's losing lots of money every time they make a car. Lucid's in bad shape. I mean, it goes on and on. Tesla is vertically integrated. Now, usually you don't want to be vertically integrated unless you're in a new industry. In this case, the EV/autonomous is a new industry, so you want to be vertically integrated. And Tesla is one of the few companies to do that. Not even Waymo, which is considered the number one EV car company in the world, perhaps. It's not vertically integrated, by the way. What else? I think there's low threats of entry for maybe I should repeat myself. There's a low threat of new entries, I should say. That's what I meant to say, in this industry. And even ICE companies, I'm talking about legacy ones like Ford, GM, Volkswagen, Audi, Stellantis, Fiat, Chrysler, Dodge. Did I see them all? General Motors. I mean, there's so many of them. They're going to have a hard time entering the EV space because their cash flows come from gas cars. And so those managers that are managing those divisions, they're going to have a hard time giving up those high free cash flows. So that's why companies that are successful sometimes cannot make the leap to new industries because it has to do with the way management's set up in these companies. So you could look at that later. There's a great book called The Innovator's Dilemma by Clayton Christensen that talks about why sometimes shabby new entrants can destroy big industries. So let's go to the next slide. So here we're talking about an example of a legacy ICE company. In this case, it's Ford. It shows you how much money they're losing. So they're selling cars. People are buying the Model E. But look at in the bottom here, EBIT and EBIT margin. It's huge in terms of huge losses. And they're getting worse. They should be getting better. So the EBIT margin, for example, in the third quarter of 2022 was minus 43.7%, which is terrible. But then it gets worse to minus 98%. So this is an example of how it's going to be very difficult for legacy ICE companies to fully enter the EV industry. And we saw this with other industries. For example, with streaming. Incumbent media companies like Disney, and there's so many other ones in Disney, Comcast, they're having a hard time making money in streaming and competing with Netflix. All right, next slide. This is a J curve. I think, well, this is not the J curve. This is a price comparison of EVs versus ICE. But my point is there's going to be a difficult time with a J curve adoption, meaning a quick adoption of EVs, if the price of EVs does not decline rapidly. And there was a pull forward. Basically, what I'm saying is the bleeding edge adopters already adopted EV. So you're not going to get your typical persons and family adopting EVs because they're worried about range anxiety. There's already been a pull forward of tax incentives. So people already jumped on that. And like I said, prices are too high. And here's an example of how you could get that J curve adoption. So here you have, and this is from ARK Invest, from left to right, you've got the price of a car. So when the price of a car goes from $75,000, for example, where my pointer is, down to about 25,000, there's a huge increase in adoption. And you can see the percentage on the left side here that the market share goes up near to 100% when the price of the EV goes down. But it hasn't happened yet, but I think this will happen. And this is why I said earlier in the presentation that Tesla should shift to having its automobiles be priced cheaper, and they should make more money on their full service driving, which they charge for on a monthly basis. We're going to talk about that later. So how are investors valuing Tesla? They're looking at the price to earnings ratio, which I think is incorrect because this year is a down year for Tesla. So you can't really value it looking that way. You're going to get some crazy P ratio of 100 or whatever. I think the best way to value companies is either discounted cash flow, which I did, by the way, but the best, or the way I did, what the way I do typically is enterprise value to forward revenues. I'm not sure if you know enterprise value. That's the market cap of the company plus net debt. So net debt is debt minus cash. So again, it's market cap plus debt minus cash. That's enterprise value. Then you divide that by not just revenues, but forward revenues. And then you get a multiple of that. And to me, this is the best way because you can value any company and any industry, whether or not it's making money or not. And it also adjusts for balance sheet cash. So what's a car maker worth? Well, if you're a legacy car maker, you're lucky if you're worth 1 times sales or revenues. If you're a premium automaker, maybe 1.3, 1.5 times sales. If you're an S&P company, maybe 3 times sales. And then I go down here to SaaS. That's software as a service. Obviously, tech companies and software companies are worth more. Here it's 7.5 times at 18% growth. Tesla, and I'm going to show you this on the next page. If you look at a regression of growth versus EV multiple, Tesla had a 12% growth for 24, and this is not my estimate. This is the analyst consensus estimates. It's worth 5.6 times. And if you look at Tesla, its low, it was worth 2 times. So the question to you is, where should Tesla be worth? So I think Tesla is valued like a car company, according to investors, not myself. I think Tesla is moving towards a tech company. But as a typical investor, I think Tesla is going to be worth between maybe around 1 times to maybe 3 times. And the low is 2 times, the EV. So the EV multiple to revenue low is 2 times that occurred in November 2019. So where could it be that? What's a good blend? I think a good blend is maybe where the S&P is trading, 2.9 to 3 times. And where is it trading right now? Around 5.5, 5.6 times. So I think the shares could go lower by as much as 40% using this multiple. And again, this is not how I feel. This is how investors feel. Remember, investors are just looking at this company as a car maker. So this is the regression I talked to you about. So if you look here in the bottom, this is year over year, next 12-month revenue growth. So the higher the revenue growth, the more the multiple. So if you regress Tesla doing this, you get doing this regression, you'll see that. I'm circling where it should be valued. Tesla should be valued around this area if it's like a tech company, because these are tech companies, by the way. So of course you have to lower that multiple because it's not 100% tech company, right? It's whatever, 30% tech and 70% non-tech. So I think it should be valued at a lower multiple, maybe here. maybe 3 times. And I think 3 times is a fair multiple because the S&P is trading around 3 times. And remember, the S&P isn't all tech companies. It's non-tech companies too. So there you have it. There's the regression. And by the way, this comes from Meritech Capital, and you can get this online. And here, what am I showing here? Oh, this is from Tesla's last earnings report from the first quarter, but it's dated April 21st. Basically, since they put up their FSD, first full self-driving version 12, there's been a big uptake in use of miles driven using this autonomous full self-driving. Again, it's not fully autonomous. This is level 2, so I don't want to confuse my viewers that this is full self-driving. It's not. But you can use it like it's fully autonomous. You just have to keep your hands on the steering wheel. And my point here, 2 points, is number one, this is the first time that Tesla is using Neuralinks. Basically, they switched from using like a million lines of code to using artificial intelligence to drive these cars. That's pretty amazing. And artificially intelligent or Neuralink driven cars are much better at driving. The driving experience is much better than it was before. So I think you're going to get a lot of mistakes short term, a lot of little mistakes, but you're not going to get big mistakes. In other words, the AI in these cars, they have common sense. So previously, everything had to be hard-coded. So if there was a cat crossing the road, that line of code had to be written in the software. If a dog or a human crossed the road, again, it had to be written in the code. But if it was not written, the car would either smash into that object or just stop. But now the AI is very smart. If it sees something crossing the road, it doesn't need to interpret and label what that is. It'll stop or veer around it. So it's a pretty smart AI. And I don't want to spend too much time on this, but the point is, it's gonna make a lot of little mistakes because it's a first version of AI. But on a positive side, it's not going to make big mistakes like smashing into something right in the middle of the road, because it has a common sense to it. It has a really smart intelligence to it. So if there's road work, it's not going to just drive on top of it. It's going to figure out what to do. So let me go over what my point. My other point here is that, and I mentioned to you earlier, they should sharply lower their prices on the automobiles and lower the cash flows from the automobile sales. But they should get as many customers as they can on their full self-driving platform. And this platform, the price went down 50%. It's only $100 a month or $8,000 for life. So I think that's a good deal. And I think that what I call the attach rate or the uptake on that's going to be good. And remember, most of the cost for these self-driving, full self-driving capability has been spent already. Even though Tesla's going to spend at least $10 billion on CapEx and AI, a lot of the cost for what they're offering now on this package that's $100 a month has already been spent. So the cash flow margin is going to be huge. And that's about it. And I also think they can work towards robotaxi. And this is what their Project Redwood looks like. This is going to help them on the road or roadmap towards selling cheaper cars. This is going to be a new, cheap, affordable car. It's probably going to sell around $26,000, $27,000, something like that. And I think it's going to sell really well because what I talked to you about earlier, remember, ARK Invest says if the price of the cars go down, the market share is going to go up dramatically. Next slide. And this is just confirming my strategy that ADAS or full self-driving capability is going to do really well in bringing in a lot of revenues. This is from McKinsey showing that level 2, you could see the revenue is going to grow dramatically from 30 to 40 billion in 2022 to 80 to 120 billion by 2030. And that's Tesla right now. But again, if you drive a Tesla, it feels more like a level 3. So it's pretty advanced. So this is just confirming what I did in my model. I'm not going to show you my model, but I did a discounted cash flow model with drivers and assumptions and all that. And when you do a model, you have to have an outside consulting firm or sell-side broker like Goldman Sachs, Morgan Stanley. You have to have someone confirming what your estimates are. Else your estimates are just out of thin air. Okay, let's go to the next slide. I don't want to spend too much time. And in all fairness, I'm showing you here that Navigant Research, which is now called Guidehouse, is rating Tesla in last place for automated driving systems. So I just want to be fair. I don't believe this. And I think this rating is really skewed towards other factors, not just the technology and technical aspects of how that Tesla FSD is used. Because I looked into the factors behind this. So it's not just the on-the-road experience. It's other things other than on the road. It's strategy and vision of the company. But somehow, Guidehouse thinks that Tesla's vision is, I don't mean vision in terms of driving the car, that their business strategy and vision is terrible. I don't know. I'm just showing you what I found out there. Next. Now, there's a lot of news about robotaxis. I believe it's October 8th, Musk is going to launch some version of the robotaxi. I think it's going to be a human-supervised, geo-fenced version like you see with Cruise and Waymo, something like that. But I think there will be robotaxis by 2028. Remember, it's a question of when, not if. And if they do have this, when they have this, I should say, I think they're going to be able to license FSD not only to legacy car makers like Ford, but to fleet operators like Uber. They can license their full self-driving. And by that time, by 2028, it'll probably be more of a truly autonomous level 4 version of FSD that I was talking to you about earlier. And again, this is going to bring huge cash flows and cash flow margins to Tesla. Tesla's stock price has been horrible. It's been going down since 2022 when the Fed raised rates aggressively. And it's still going down, but now it's going down because of weak pricing and weak deliveries. And I talked to you about that before. And Elon Musk is overstretched, as we know. He's dealing with his compensation plan. He's dealing with Twitter/X and Grok AI. And he's in the news like a million times a day. And this is affecting Tesla buyers and sentiment on Tesla investors and the Tesla buyers of the cars themselves. So again, I think there's a huge support, not only from an EBITDA multiple basis, but the support technically in this area where I'm putting my finger or my pointer on, the support around $100 per share, but that's still a big decline from where they're trading now, which is around $175 a share. They have other businesses that are doing quite well. They got solar, they got residential, commercial, they got storage, again, residential storage, commercial storage, and they got insurance, which I think is just a service to customers that can't find good insurance. But where the money is and where the growth is and the margins in terms of cash flow margins are the commercial battery area. And this is from Grandview Research showing there's going to be a huge 30.5% compound annual growth of the U.S. battery energy storage market. And again, I've got a discounted cash flow model with projections, with global projections and U.S. projections, and I use these projections from third parties to support my strong revenue growth for the energy segment of Tesla. And you can see that grid storage is quite high here. And that's where Tesla's going to make a lot of the money from storage, from the mega packs that sell for like, I think it's 1.5 million plus installation cost. And there's a huge backlog for them, by the way. Now, Tesla also has a charging business, which is in the news lately because Tesla had a huge layoffs. And so I don't think their cash flow is that good. But according to the IEA, there's going to be huge growth in charging stations. And you can see here on my pointer is it's going to grow from 2.5 million, I think this is ports or charging units, to like 12.5, over 12.5 million. So it's a huge, huge increase. So I don't think the charging unit for Tesla is dead yet. And remember, Tesla's is going to be, licensing and allowing other car companies, almost every single car company in the world, to use its charging units now. So they're going to reap more cash flows from that. And lastly, this is my revenue forecast for what I call the Tesla core business as we know it. I think we're going to move slightly in revenue. So my revenue growth is very low. I think we talk later. I think everyone's got a high revenue growth, and I showed you that earlier. Maybe I could just go back here. Let's see. Right here, there's a 12% revenue growth forecast. I don't think we're going to get that. So you can see my number is very low, like 2.3% for this year for revenue growth. So this is billions, by the way. So it's basically flattish. Same thing with unit sales. But then I think we're going to take off again. As I said, I think the industry is going to do better, and that Tesla is going to be a leader in terms of lowering car prices so they get that adoption. And then they're going to be selling trucks, but not now, more like in year 4. And I think they're going to reap a lot of FSD revenue. As I mentioned, FSD is now $100 a month. I think there's going to be quick adoption. So we're going to go from $500 million to $1 billion in revenues to $2 billion to $4 billion to $5.5 billion. I really think we can get a rapid adoption, not only in revenue growth for FSD, but in cash flow growth. And then we got adoption of insurance, but I think it's going to bleed cash flow. I think charging's bleeding cash flow, and even maybe services. And energy generation is bleeding cash flow, but as I mentioned earlier, it's a very, very good industry. And I think they're going to be rapidly growing cash flow in this industry here. And you can see I'm forecasting $24 billion in cash flow by year 4. And the last thing I want to talk to you about is EV to revenues. Right now, they're trading over 5 times EV to revenues. Which is about a market cap of $550 billion. And for this year, I've got them around $500 billion, $495, out of 5 times EV to revenues. But again, as I mentioned earlier, investors are going to see this as being too high. And remember, they bottomed in November of 2019 at only 2 times EV to revenues. And 2 times of 98 million, it's called out $100 billion. It's $200 billion, meaning the stock price could go down dramatically. So what's my key takeaway to you guys? I sound like I'm really bearish on this company. I am actually short term, but long term, there's a lot of potential. So I think that Tesla shares could go down dramatically, maybe as much as 40%. But we should use this to do DCA, dollar cost averaging. We should take advantage of this. If Tesla's stock price goes down, especially if the market goes down, we should take advantage of that and start being disciplined and purchasing these shares at a low price. Because long term, I think there's a lot to like for Tesla. And I didn't talk to you about my discounted cash flow model, which includes robotics, the robotaxi. In that model, Tesla's worth much, much more than what I think investors are valuing the company right now. Well, I hope you enjoy this, and I'm going to show you another presentation on the discounted cash flow model in the future, and I hope you like it. Bye bye.